to discuss forex trading. We're looking at module 6, professional trading ethics and best practices. In forex trading, technical skills alone are not enough for long-term success. Professional traders must also develop strong ethical standards and disciplined behaviors that guide their decisions in both favorable and challenging market conditions. At the end of this module, students should be able to define trading discipline and explain its importance in forex trading. Explain the concept of market integrity and its role in financial markets. Identify key do's and don'ts in forex trading practices. Apply ethical principles to decisions and behavior when it comes to trading. Demonstrate responsive, responsible financial decision making in trading activities. Recognize fraudulent schemes and avoid deceptive trading practices. Explain the impact of unethical behavior on financial markets. Develop sustainable trading habits that support long-term success. Analyze differences between discipline and emotional trading behavior. Evaluate real-world scenarios involving ethical and unethical trading practices. Then lastly, you should be able to apply best practices to maintain consistency, discipline, and professionalism in trading. Of introduction, professional trading is built on consistency, discipline, and integrity. It is not just about making profit, but about making decisions that are structured, responsible, and sustainable over time. Trading discipline refers to the ability to follow a well defined plan without deviation. It ensures that traders act based on strategy rather than emotions or impulse. Market integrity ensures fairness and transparency in financial systems. Without it, markets become unreliable and vulnerable to manipulation and fraud. Ethical trading involves making decisions that are honest, transparent, and aligned with accepted financial standards. It protects both the trader and the broader financial system. Sustainable trading habits allows traders to operate consistently over time. This includes continuous learning, risk control, and maintaining emotional balance. Let's look at what trading discipline is. Trading discipline is the ability to consistently follow a predefined trading plan. It involves setting clear rules for entry, exit, and risk management, and sticking to these rules regardless of market conditions. This is known as trading discipline. Effect of lack of discipline when it comes to trading. When traders lack discipline, they may enter trade without analysis, ignore risk management rules, overtrade, and react emotionally. These behaviors often lead to inconsistent results and long-term losses. Let's look at the next term, which is market integrity. Market integrity ensures that all participants operate in a fair and transparent environment. It allows traders to trust price movements, data, and execution systems. Let's look at unethical practices. Unethical practices include spreading false information, market manipulation, misleading clients. These actions damage trust and can lead to severe regulatory consequences. Let's look at some of the do's in professional trading. Professional traders should follow a structured trading plan, apply risk management consistently, analyze before entering trades, maintain records of trading activities, continuously improve their skills as a trader. What are the don'ts in forex trading? Traders must and should avoid trading without a plan, indiscipline, risking excessive capital, acting based on emotional trading, over trading, relying on rumors or unverified information is a no when it comes to forex trading. Let's look at ethical trading practices. Ethical trading requires transparency, honesty, and responsibility. Traders must provide accurate information, avoid misleading others, and operate within regulatory guidelines. Let's look at responsible decision making. Responsible traders set realistic expectations, they manage their risk carefully, they avoid excessive leverage, and they make decisions based on analysis rather than speculation. This is what responsible traders do. First, they set their realistic expectations, they manage their risk carefully, very carefully, and they avoid excessive leverage. They don't do excessive leverage. And they make decisions based on analysis rather than speculating. Fraud awareness. What is fraud awareness? Traders must be aware of fraud in the forex exchange. Traders must be able to identify fraudulent schemes such as guaranteed profit promises. Somebody's telling you, I'll teach you how to trade and you are going to make $1,000 per week. You are going to, all these are guaranteed profit promises and they are fraud. They are likely fraud. Lack of transparency. Pressure to invest quickly. You are in a platform and they want you to put in all your money. Beware, it's a fraud. They're an unverified trading platform. I already told you MT4, MT5, and TradingView. These are the platforms I recommend for forex trading. Developing sustainable habits. Long-term success depends on developing habits such as discipline, consistency, risk control, and continuous learning. Under discipline, I already explained what discipline is. Consistency is sticking to your discipline. Risk control is managing risk. Should I go for the big risk now or take lesser risk? Then we have continuous learning. Continuous learning. These are sustainable habits when it comes to forex trading. Let's look at some key trading habits. Successful traders review past trades. They learn from past mistakes and they adapt to market conditions and they maintain emotional control. These are key trading habits when it comes to trading. Review your past trades to understand trends. Learn from past mistakes. You adapt to the market conditions. Maintain emotional control always. Let's look at trader behavior comparison. Disciplined traders follows plan. They manage risk and remain consistent. While emotional trader, what do? They act impulsively. They increase their risk and experience unstable performance over time. Let's look at market integrity scenario when it comes to fraudulent activities in forex trading. When false information or manipulation occurs, markets become unstable. This reduces trust and can result in financial losses for the participants. Now, by way of conclusion, this module has explored the importance of professional trading ethics and best practices when it comes to the forex markets. Okay, it emphasized that successful trading is not only about technical skills or the market knowledge that you have, but it's also about discipline, your integrity, and responsible behavior as a forex trader. This module introduced the concept of trading discipline and how consistent application of a structured plan leads to a more stable result. It also highlighted the importance of market integrity and how ethical behavior continues or contributes to a fair and transparent trading environment. So basically, this module covers um, how to be disciplined, how to have market integrity as a forex trader, how to be a responsible trader. Because if you do not do all those things, you will make more losses. But if you follow the structured plan, you have discipline, you are responsible, it will lead to a more stable result. You will make losses, but your losses will not be as more as they should have been if you do not carry out this ethics when it comes to forex trading. Like emotional trading, we looked at the do's and don'ts. What's the things you should do in forex? We looked at the core do's. Then we look at the don'ts. What are the things you should never do when it comes to forex trading? We looked at that too. By the end of this module, there's an assessment session where part A is 15 MCQ quiz, and you have to write a report to test your better understanding of this module. I'll see you in the next module.